Verizon offers investors a dividend yield of 7.76%. But how sustainable or how safe is that dividend yield? Well, I want to answer that question in this video, looking at its cash flow, its debt, and its earnings in relation to its dividends. So let's jump right into it and answer if Verizon's 7.76% dividend yield is safe. And one thing I look at when I'm measuring the safety or the sustainability of the dividend yield is how much dividends per share incorporate into earnings per share, or what proportion of earnings per share are paid out in dividends. For Verizon, it's a smaller amount. So earnings are well ahead of dividends per share. Earnings per share have been ahead of dividends per share for the majority of the last decade, and that represents a sustainable, for the most part, dividend payment. What that shows is that the company is spending less on its dividends than its earnings. So there's a gap enough for the company to reinvest in its business and pay the dividend without going excess of earnings per share, because the only way it can support being in excess of earnings per share is through debt or using up its savings, and that's not sustainable in the long term. Which is what I wanted to look at next. I wanted to look at its total long-term debt and its savings, or in other words, its cash and equivalents. And looking at Verizon's long-term debt, it's absolutely massive at $152.7 billion in long-term debt and $4.8 billion in cash. So there isn't much room for Verizon to support its dividends through borrowing more or using up its savings. So it's a good thing that the company's earnings are in excess of its dividends per share, because if they weren't, then there isn't a backup here for Verizon to support the dividend with saving or borrowing. And the last thing I wanted to look at is its cash flow from operations over a trailing 12-month period. And I wanted to go back a decade to see how various changes in the economy impacted the business. And even in its worst, Verizon generated more than $15 billion in cash flow from operations. Recently, in the most recent trailing 12-month period, the company generated $37.5 billion in cash flow from operations. And so the company is generating significant amounts of cash flow to support a dividend payment. Also, when I compared the cash flow from operations to its long-term debt of $152 billion, it looks like it generates about 1/4 per year of its total debt amount in cash flow from operations. Roughly, rough estimates, because both of these numbers fluctuate. The cash flow from operations more so than the long-term debt. But if the company wanted to pay down its debt using all of its cash flow from operations just to pay down debt, it could do so in about 4 or 5 years. Now, that's unreasonable because the company does need to use some of that cash to reinvest in the business. But just hypothetically speaking, if it wanted to allocate all of its cash flow to pay down debt, it would take about 4 years for Verizon to pay off all of its long-term debt, because it generates such strong cash flow from operations. In a more reasonable scenario where it wants to aggressively pay down debt, let's say it wants to use half of its cash flow, $20 billion, it would take about 7 to 8 years to pay down its debt. And the more it pays down the debt, the easier it will be to pay down the debt, because the interest expense will decrease every time it pays off one of its loans, and thereby increasing earnings and increasing cash flow, making more cash available to pay down even more debt. So that can hasten its ability to pay down the debt. So while it does have a significant amount of debt, it also generates very significant amounts of cash flow from operations to support paying down the debt. So if I was to answer if Verizon's 7.76% dividend yield is safe, I can't say yes. I can't say absolutely, unequivocally, that dividend yield is safe. There's little chance for management to reduce that dividend. I can't say that because of that massive load of debt, because of that significant amount of debt where management might strategically want to allocate some of that money it's using for paying dividends to pay down that debt, because it would become such an opportunity for them, right? If it comes to the point where it needs to refinance, let's say $20 billion in debt, and it needs to refinance at, I don't know, 10%, let's say interest rates increase and it has to refinance at 10%. And then management has this choice. Do we keep paying this dividend, or do we use some of that this year to pay down this debt, which will then decrease our interest expense and increase our earnings and increase our ability to pay dividends sometime later next year, maybe? And so management might make that strategic decision to pause or decrease the dividend payment to pay down some of that debt. So I can't say yes, it is safe, but I'm also not going to say no, it's not safe, because the company does generate nearly $40 billion in cash flow from operations. So it's not like the business is at risk where its cash flow or its earnings are not sufficient to support. It's the question mark is the debt. Will they make the choice, the strategic choice, to pay down the debt instead of paying the dividend? So I would say somewhere in the middle for Verizon, safe or not safe when you're looking at this dividend yield. So if you're trying to invest in a stock that's going to pay the same dividend or increasing dividends for sure over the next decade, then I would say Verizon, it might not be for you, because there is a chance it might pause or reduce that dividend payment to pay down some debt.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.